those questions. All right, so today's agenda, as the final piece of our currency returns model framework. So up to this class so far, up to the midterm, we've basically combined two markets, right? We've combined the financial markets as represented by the UIP equation, financial markets from the perspective of foreign exchange, as well as the money market. The money market is just the market that determines interest rates. So real money demand and real money supply market clearing condition gives you interest rates. The last piece of the puzzle is now linking all of this, essentially financial markets in general, with the real market, the real economy. So when I say real economy, I'm talking about units of goods and services, not just nominal units of dollars and Hong Kong dollars, Japanese yen, Chinese yuan, whatever. We're talking about tangible, real goods and services, and we want to see how the spot exchange rate can be influenced through Y. So we already saw Y, right? Y fits into the liquidity preference function, but now we're going to expand that function into an entire new framework. Okay, new framework for those of you who have no background exposure to macro, but here today we're just borrowing another piece of macro, which is how to model aggregate demand. Okay, so this is the Keynesian demand function. This is something you may or may have not seen in macro. This is a very core concept in macroeconomics, at least for the undergraduate level. So I hope there's some exposure. If not, of course, we'll explain the formulation, how to derive, how to shift different curves, and hopefully provide a little bit, remind you what the intuition is and how to adjust another graph in terms of shifting curves and whatnot. Okay, so that's our task, is to build this aggregate demand function, okay, which allow us to understand how output is determined and how output can be influenced by government spending, by consumption, by taxes, and most importantly by Q, right? Q is the key here, right? Q, or the real exchange rate, is the key that links the real economy with the exchange rate. And today I'm going to talk about the role of Q and the role it plays in influencing the current account. All right. So before I get to the main slides, I will now talk about how to interpret now the current account into the so-called value effect / volume effect. So I kind of didn't want to go too much into detail the previous weeks because I didn't want to burden you with potentially non-intuitive explanations of how to read the CA function. Okay, but today we kind of have to dive into the math to figure out exactly what the value effect is and what the volume effect is. And this is going to require some calculus. But if you don't have the background, that's okay. You can just memorize the identity that I prove in a bit. All right, so one part of the current account equation that might be confusing, maybe, is how to actually convert this IM of the current account equation, the import part of the equation, into Q times EX star, right? I kind of gave you a hand-wavy explanation of how to interpret IM in terms of domestic units, right? Domestic currency, or in this case, domestic output. So now I'm going to try to give you a concrete conversion of how to go from thinking about the current account in terms of just dollars and nominal units, now in terms of actual real units, output units. So when I say output, I mean like, imagine we can theoretically come up with a theoretical concrete unit of goods and services that we can sell for a certain price. Okay, that's what we're trying to do now. All right, so let's go ahead and try to explain to you why we can make this conversion here, going from IM to Q times EX star. All right, so I'm going to start with the CA equation. So for the past few weeks, or the last 2 weeks, we've primarily thought about the current account in terms of savings investments, right? S minus I. Total savings, which includes savings abroad, minus domestic investments. This lecture, we will focus on the real side of the interpretation of CA. So the CA now is going to be approximately equal to EX minus imports, right? This equation, burn it into your brain, all right? Now we're going to apply more structure to this equation. CA can be influenced by many things. Yes, we talked about Q, but can also be influenced by the propensity to import given additional income, right? Disposable income. So I'm going to add another parameter here, but don't think too much about it for now. Okay. So for now, just imagine we can think of the current account being influenced by two variables. One by the price ratio, right? Represented by Q. Again, Q is the propensity to import, given how expensive foreign goods and services are, right? And Y minus T is our representation of disposable income. Y, again, is total output that's sold, right? Either domestically or abroad or produced. And whenever it's sold, domestic citizens earn money, right? That's the income. That's what Y is. T here represents taxes. So whatever a household or company doesn't use to spend, has to give up, right, to the government because they have to remain as a to continue doing business in the country, or they have to pay taxes, or to live in the country. For households, they have to pay taxes. So whatever is left over is called residual income or disposable income. Okay, that's what they can use for investments, for consumption, whatever. All right. So far so good, right? It's so far intuitive. All right, we can do the same for exports and imports, right? Exports and imports are also functions of these parameters. So as you can imagine, Q, again, the inclination for countries to exports is conditional on how expensive their goods are relative to other goods. That's what Q is. Okay, IM and EX both have the parameter Q. So again, the relationship between Q and EX, domestic exports, is positive, right? Q is defined as foreign prices divided by domestic prices. And so if foreign prices increase, that means Q increases. Domestic exports most likely to increase as well, right? Because again, if foreign goods are more expensive, domestic citizens will substitute away from foreign goods in preference for domestic goods. For foreigners, it's the same logic. If their goods and services are more expensive, they will substitute away for the cheaper goods. So Q will definitely have a positive effect on EX. Okay, this is all review, right? This is all review. All right, IM, on the other hand, is a bit ambiguous, right? When Q increases, we know two things must happen. We still have this price effect coming from the propensity to export-import, but now we have the so-called value effect that arises, right? And I kind of explained to you in the previous weeks that this value effect just comes from exports and imports not moving and just the relative price levels increasing. And I'm going to show you mathematically why that will show up in the equation, okay? So this Q, we'll put a question mark here for now. For disposable income, it should also be kind of obvious too why this has to be negative, right? And this has to be positive, right? So if you're making more money, so remember, without the star, it means it's domestic disposable income. So Y minus T, domestic disposable income. If you have more money at hand, you're most likely to consume. As part of that consumption may be in foreign goods and services, imports. So as you have more money, you're more likely to import certain goods and services. So there's a positive sign here. Y star and T star is foreign disposable income. So if you are if the foreigners are wealthier, they're most likely to also import goods and services from you, right, domestically. So this is going to be a positive relationship here. Yes? So more foreigners getting more wealthy, most likely to import from you, the domestic country, which is our exports. All right, so that's the expanded framework you're going to see in the main slides very soon. But I'm just going to show it to you now so that when you see it, it's not going to be so much a surprise. And now you kind of understand each moving part. So let me summarize again. Without looking at the right-hand side, just on the left-hand side, it's clear that the current account, again, current account is just a representation of net exports, positive related with Q, as far as we know, right? And also negatively with disposable income. Because the more money we have, the more likely we're to import, right? That's kind of the intuition. Now the right-hand side, we'll just break it down. This export function, also quite intuitive, right? Based on what we know from the last few weeks. We have higher Q, more expensive goods and services abroad. That means everyone's going to be substituting away from foreign goods and services for domestic. That includes both both domestic citizens as well as foreigners as well, because they're going to substitute away from their own goods in preference for our goods. So higher Q will definitely drive EX upward, right? So there's a positive relation with Q for EX. Y star minus T star, that's disposable income of the foreigners. Again, just like here, wealthier foreigners more likely to buy things, and part of that consumption or purchase is going to be from domestic, our exports. So here is going to be positive relationship with us, right? With our exports. The last component, IM, Q is ambiguous, and I'll show you why. So put a question mark here for now. Y minus T, domestic disposable income. As we become wealthier, part of our additional consumption after we become wealthier is going to go towards buying stuff from abroad, right? That's imports. So here it's clear to see that imports or the disposable income is negative related with the current account. Yes? So Q is the question mark, right? Why is it a question mark? Which is my task today to explain to you mathematically. Okay. All right. So that's step one. I just gave you an expanded framework to understand the current account. Number two, how to rewrite imports in terms of Q times IM star. Sorry, EX star. So let me give you the intuition of why we can write it this way. So if you recall from last few weeks, real exchange rate is defined in this following way. Q equals EP star over P. Maybe for a lot of you, when you see that equation, you're just thinking about price levels. But whenever you see price, whether it's in this class or another class, price always has a per unit quantity, right? So you look at stock prices. The stock of Google. It's not just, $100. It's $100 per unit of Google stock, right? 1 unit of Google stock. So in the same way, you can think of these P and P star in the same way. P star is a price per unit of domestic output. Yeah, some abstract quantity of output. Just think about what P star represents, right? It's the price, for P, it's the price of, if you want to buy 1 unit or one theoretical unit that represents a basket of goods and services for the domestic country. Okay, so P, therefore, you can think of price per unit domestic output unit. So this is very abstract, right? But it will help you understand why you can make this conversion between IM to Q times EX star. Same thing with P star. So again, P star, while it is a price level, all prices correspond to per unit of something. So in this case, think of per unit of foreign output. Right? So these two equations here, I haven't really changed anything, right? I haven't changed any variables. I've just told you that now prices are per unit of something, right? So P star is per unit of foreign output. P is now per unit of domestic output. All right, so let's rearrange everything so that we still have EP star over P. Okay, so that goes in the numerator. And we can rearrange these output units as well. So let's just move everything around so that it looks nice. And you'll see that Q can be interpreted as domestic output unit foreign output unit priced in domestic output units. Yes? So this is another way of thinking about what Q really represents. While it is a price ratio, but it's also pricing something, right? It's pricing real goods and services of foreign output specifically in terms of domestic output. So let me say that again. Q, therefore, is equal to the price 1 unit of foreign output in terms of domestic output. And this price is represented by EP star over P. This variable here goes in the numerator, right? That's how you should think about it. All right, so just to repeat myself, I have not changed the math. The math is still there. The only difference now is I've expanded the definition of what P star and P represents. It's the price of an abstract quantity of goods and services from a particular country. You can do that for P star and also P. So at the end, when you rearrange all the terms, Q actually represents not just price ratios or an incentive to export-import, but also we're pricing foreign output in terms of domestic output. And this EP star over P, that's the price associated with the foreign output. All right. So then the interpretation here of IM equals Q times E star should be quite straightforward then, right? So we can read this equation here, this substitution here, just in terms of plain English, in terms of this kind of English, okay? Imports measured in domestic output, that's IM. Remember, when we write it this way, it's all in the same units, right? All in domestic dollars, yes? CAs in domestic dollars, EX, IM, all in domestic units. But when you see IM, how do we read that? Well, it's imports in terms of domestic output. When we write it in terms of this equality, Q times EX star, we can therefore just interpret Q and EX star in this framework. So Q is domestic output units per foreign output unit multiplied by imports measured in foreign output units. That's what EX star is. So if you can cancel out foreign output units with foreign output units, and at the end you get domestic output units. All right, so let me say that again. IM equals Q times EX star. This may be confusing for some people because I gave you a very hand-wavy explanation in the past few weeks. Here is a rigorous explanation of why we can interpret it this way. It's because Q represents not only price ratios, but also the price of a foreign output unit in terms of domestic output unit. Then looking at this equation, it's quite clear that we can do this. Because if we write out Q times EX star using this alternative explanation, we can therefore read this equation as domestic output units per foreign output units, which is exactly this ratio here, multiplied by imports measured in foreign output units, which is EX star. Foreign exports is our imports, right? That's the interpretation. OK, so any comments or questions about this explanation and why we can replace IM with Q times EX star? So I hope this explanation, after redefining Q in this way, going from this equation here to this equation here, should not be, there shouldn't be a logic gap, right? It's all clear now, right? There should be no logic gap now. All right, so let me summarize the slide what we did. First things first, as you'll see in the rest of the slides, I've expanded the current account equation to incorporate two parameters, Q and disposable income as represented by Y minus T. Y is a representation of national income. T is taxes. So whatever is left over is disposable income or residual income that firms can use to make investments, to do whatever. All right. So if CA is parameterized this way, then exports and imports can be parameterized in the same way. Q is going to be positive related with EX, again, because as foreign goods and services become more expensive, meaning Q increases, more people will substitute away from the more expensive goods for domestic goods, which is cheaper, relatively speaking. So EX will increase when Q increases. Imports, on the other hand, question marks. And I'll explain to you in the next slide. For disposable income is also quite straightforward. As foreigners become more wealthy in real terms, they will increase or elevate their consumption, and some of that consumption will go towards imports. Their imports is our exports. So that's EX. So disposable income increase for foreigners, that's going to increase domestic exports. For imports, also straightforward, right? As we become wealthier, a lot of our consumption may go towards foreign goods and services. That's going to increase imports. And that's why current account will move negatively with Y minus T. So that's number one. Number two is explaining why we can replace IM with Q times EX star. The reason why we can do this is because we can interpret Q not just a price ratio, but also a way to price foreign output in terms of domestic output. And so EP star represents the price of foreign output in terms of domestic output. In this formulation, then IM equals Q times EX star is kind of just mathematically true, right? It has to be true. Okay, and you can read this out loud to yourself in English, right? Q is domestic output per foreign output unit. EX star is imports measured in foreign output units. Cross out, just cancel out the numerator and denominator, and all you're left with is domestic output units, which is precisely what the units should be when looking at the current account for a specific country. All right. Comments, questions. So now we will move from here to here, and now we will revisit that value effect, volume effect concept that you heard in week 1. Okay. Okay, so this is the calculus stuff, which I may lose some of you, but the derivation itself is not important. Okay, it is the final result that's supposed to convince you why there is such a thing as so-called value effect and volume effect. So what I've done here is simply take the partial derivative of the current account with respect to one of its parameters, Q. So why am I doing this? The reason I'm doing this is because I want to understand how changes in Q will yield a change in the current account. That's our final objective. As policymakers, we want to know how to influence exports, imports, if we decide to provide guidance on how E should evolve over time. Yes? That's kind of what we want to do as policymakers. Is there a question? Is there any questions? Yes? Is there a question? Okay. if you have a question, by all means share it, and I can answer it. So if there's any, I don't want to lose people in this topic. So this is probably the hardest part in this class. Okay. After this last 2 lectures, the rest is kind of just review of risk management topics, which you've seen in other classes. So if there's any point in time something doesn't make sense, this is the hardest part in the class. Okay. Okay. No questions. So as I said, we want to understand the sensitivity of the current account in response to Q, which is this is the variable that links kind of the financial side with the real economy. So we take the first derivative, starting from here, right? We know that the current account is equal to EX minus IM. Replace the IM with Q times EX star. We know this can be done because of the previous interpretation that I showed you in the previous slide. Yes? Take the derivative of CA with that single parameter Q, holding all else equal. Okay, that's what partial derivative means. Hold all other parameters constant. Then we can just apply the product rule. Okay, so again, you don't have to know what the product rule is. You don't know calculus, but just know that if I apply the product rule, you get this following expression. So how do you read this? This is saying that if I change Q by just a little bit, the change in the current account should look like the following. EX should change by something, minus Q times EX star should change by something, plus EX. Okay? This is after applying the so-called product rule in calculus. Now the easy part. Okay? After doing the product rule, we're just going to rearrange the terms into something that looks manageable, or at least easy to interpret. Let's just group all the terms that look like they should be positive, right? Namely the exports, and just leave out the last part that's with the minus. So just by rearranging terms after applying the product rule on the current account, taking the partial derivative with respect to Q, you can already see the volume effect, which is the sensitivities of exports with respect to change in price levels, relative price levels. And the list lingering part to be the value effect. So what does this mean? This means that the current account, the way it responds to Q, is somewhat ambiguous if you don't make some proper assumptions about this structure here, right? We kind of have to assume that this entire structure has to be positive, right? To say that Q has a positive effect on the current account. So up to now, we kind of assumed that this volume effect overshadows this minus effect, right? This minus EX star. And so we'll impose some assumptions for us to conclude that the change in the current account with respect to change in Q must be positive. So let me talk about why these parameters are positive or negative. Okay. The change in exports, domestic exports, with respect to change in Q, this should be positive. Why? As we saw in the previous slide, right? If foreign goods and services are becoming more expensive, people will substitute away from foreign goods and prefer to buy or consume domestic goods. Exports must respond positively with respect to increases in Q. Okay? Something we all know. This part. If foreign goods and services, if foreign price levels are increasing, as we see from Q, increase in Q, then the change in foreign exports should be which direction? Positive or negative? Yes, negative. Right? Because if their goods are more expensive, everyone's substituting away from them. So their exports are going down, and our exports going up. Right? So this is negative, multiplied by a negative. Q is always positive because it's a price ratio. So this entire expression here must be positive. This is why we call this the volume effect, because everything here we're talking about changes in trade flows, exports, whether it's from domestic or from foreign, right? It's all about trade flows in response to relative changes in price levels. Now this part, this is what we call the value effect, because we're not talking about trade. We're just talking about goods and services abroad being more expensive, right? That's why it's hurting the current account, because all else equal, if we ignore the volume effect, what a price level change in fact is saying is that their goods and services are more valuable than ours. And that's going to undermine our current account level mechanically. So the question, empirical question for economists or for investors in general is, to what extent, over what time horizon should this relationship be positive, and under what circumstances would this relationship be negative? So I'll show you in either this week or next week what's called the J curve. The J is called the J curve because the response to changes in Q, either from a policy shock or from government guidance on how E should evolve over time, there will be a temporary decrease in the current account in the very, very short run. The reason is quite intuitive and practical, right? The reason is because in the very short run, trade volumes are not expected to move, right? All orders have in place in the short run. Nobody's really going to change those trade orders in the very short run, and these dynamics are essentially held constant over, for example, a few months up to a year, right? It's only in the very far future where we should think about trade flows that really matter. So in the very, very short run, over a few months, for example, this effect is going to dominate, and therefore the effect on the current account in response to price shocks, in response to changes in E, because, for example, central government wants to peg or depeg a currency, that's going to have a negative effect on the current account as a result. All right. So perhaps I can summarize again, okay? So the point of this slide is to revisit the idea of volume and value effect and give you precise mathematical structure of why there is ambiguity in the way Q influences the current account. So far, when we study, for example, the international gold standard, and we study the current account effects in the previous few weeks, we've assumed that Q has a positive effect on the current account. So that's kind of, again, I made a lot of assumptions, and now we're going to be more precise in what those assumptions are. And the reason why we need to do this is because of the following, because we can now show you precisely where this ambiguity comes from. So we start with the current account, and we've just focused on the parameter of interest, right, which is the Q level, the price ratio. We know from the previous slides that we can decompose EX minus IM into EX minus Q times EX star, right? Because we can interpret we can interpret Q as the price of foreign output in terms of domestic output. That's why we can replace IM with Q times EX star. After doing that, from policymaker standpoint, from investor standpoint, we want to understand how trade flows are impacted by price changes. We can do this mathematically by taking the partial derivative of the current account with respect to Q. All we're doing is just applying what's called the product rule. If you don't know what it is, that's fine. Just know that the final result is here. After grouping terms together, we see that what we've done is grouped exports, the effects of exports with respect to Q in one part, and a level, right, a level component here. These parts, these two parts, these dynamic parts are called the volume effect because we're looking at how exports change in response to Q, right? These are dynamic. These are dynamic equations here. They're differential. They're derivatives, right? Derivatives means change of something with respect to change of something else. So when we say something's the volume effect, we're looking at changes in response to the change in price. But here, we don't see any changes. There's no deltas. There's no partial derivatives, right? It's just a simple level variable. What this part is just saying that it's a mechanical effect coming from the fact that price levels are being elevated, increased. And that's going to undermine the current account because, again, the interpretation is that their goods and services are worth more than ours now. All right, so this week or maybe next week, I'll give you a condition, there's a name to it, that allows us to conclude that this is positive. Okay? And this is critical for us to kind of make forecasts about how government spending impacts the spot exchange rate and so forth. Okay, we have to impose that assumption to kind of see how government spending, taxes, and so forth impacts the spot exchange rate in the short run and long run. All right, comments, question on this revisiting the current account equation now. So now we fully understand this third interpretation of the current account, right? First one is S minus I. Second one is just exports minus imports, kind of just a fuzzy idea what that is. Now you truly know what we're talking about here. We're talking about flow dynamics coming from price incentives. Also, you can think about imports, disposable income, how that influences imports and exports, and now you understand where this value effect comes from as well. And then we have to kind of think about what conditions allows us to kind of ignore this value effect component in this dynamic equation here. All right, so comments, questions. So again, you don't need to know the calculus. You just need to know, if I ever ask you something, you probably just need to know this equation here. You can just memorize it. But of course, being able to derive something is always pleasurable. I don't know, at least from a math perspective. But if not, then memorization you should probably commit to memory. All right. So if no other questions, let's start this lecture. So this lecture is focused on still flexible exchange rates. We'll talk about fixed exchange rate, pegged exchange rates in 2 weeks or 1 or 2 weeks, okay? But we're still working under the assumption that all countries, all counterparty countries, domestic country, foreign countries, all have flexible exchange rates. Again, it just means that there's no manipulation of the spot exchange rates. There's no guidance from the central government or from the central bank. It's all subject to international trade and price pressures from the financial and money markets. Okay, that's what flexible exchange rates means here. Now our task is to link these financial markets, right, the money market and the foreign exchange rate markets, with output, because at the end of the day, we want to understand how FX markets can influence the real economy, either domestic or foreign, right? And we're going to still be stuck in the short-term model. So we're not, now you kind of put aside, you can now put aside like this, the real PPP stuff aside for now, okay? So let's go back to week 5's framework, okay, before relative PPP stuff. All right, so hopefully by the end of today, I will just cover up to 3. But if we have extra time, I may move on a little bit more. So today, my task is to introduce to you the aggregate demand framework, okay? And then try to explain to you how that aggregate demand framework is linked to the existing models we saw last 2 weeks, right? The UIP and the money market. Okay, so let's review a bit what kind of tools we have at hand and what framework we're working with. So for now, we're working with nominal interest rates, exchange rates, price levels, and we all know they can impact output can impact these things in the short term, right? Why? Because in our liquidity preference function, we have R and Y, right? Depends how Y is affected. We haven't really discussed how that's affected, right? I'm telling you now that there's two things to think about when it comes to Y. Number one is a government spending shock, like consumption vouchers in Hong Kong. That's an example of consumption of government spending. But you can also think about tax cuts, right? These are two fundamental fiscal policies that's implemented basically everywhere. Tax cuts could be an example like if a country wants to incentivize innovation, they can give startups a tax rebate. So if they spend money on R&D, the government just pays them for the R&D that they spend. That's an example of a tax cut. Why do they want to do that? Well, they want to incentivize R&D, right? They want innovation. And now we want to eventually come up with a framework to kind of analyze how these tax cuts or government spending impacts the spot exchange rates and how that potentially could feed back into overall output of an economy. Okay, so things are getting really dynamic now. We're talking about feedbacks here. All right, so objective. We want to understand macroeconomic policies and its impact and output in the current account. So the link between financial markets and the real economy is through the current account, and it's linked through that single parameter Q, right? The price ratio. So up till now, we focused on the financial side primarily, right? S minus I. Total savings, global savings, domestic savings, and savings abroad, minus domestic investments. So whatever is left over is investments abroad, essentially. So now we are going to focus on this approximation of the current account in terms of EX minus IM, right? Which we just talked about, the previous slide a few minutes ago. Okay. So my objective for you today is to introduce to you the Keynesian model of aggregate demand. So if you don't know who Keynes is, that's fine. It's not important unless you're a historian, you may want to care about this. But the basic idea of the Keynesian aggregate demand model is that we want a framework that's tractable for us. Okay, that means easy in terms of mathematics. But there is also an intuition to it as well. The Keynesian model of aggregate demand basically says that there will always be enough supply to meet demand in equilibrium. Okay, so let me say that again. The Keynesian model of aggregate demand essentially states that supply in equilibrium will always be enough to satisfy overall demand in the economy. So what that means is that all we have to do is model an economy's demand for goods and services. So long as we are able to model that, we can safely assume that enough output will be produced to meet those demands. Okay, so demands not only consumption today, but also consumption tomorrow, 1 year from now, 10 years from now, and so forth. So every country essentially will produce as much as they plan to spend. That's what Keynesian model of aggregate demand essentially means. Okay, so I will give you the mathematics and the graphs to show you what supply meets demand, or demand creates supply. Okay, essentially demand creates the supply. Okay, so after giving you the Keynesian model of aggregate demand, I will merge it with this monetary approach to nominal exchange rate E. So remember the monetary exchange rate is UIP plus money market, right? That T graph, right? That's been rotated, right? I'm going to merge it with that model. Okay. So in the end, the final graph we want to work with is exchange rate in the y-axis and output in the x-axis. This is the new model we kind of want to focus on. So as a comparison, the short-term model is the rotated T, right? We have interest rates, exchange rates, and real money demand or supply. Here, the final graph we want to work with is exchange rates on the y-axis and output on the x-axis. Okay, and we're going to try to summarize all markets with this graph. All right, so in this class, I'm going to assume that investments does not respond to interest rates, just for the sake of simplicity. Okay, so now I won't ask you any exam questions about changes in investments unless it's outside of the model. Okay, And we're going to assume that investments does not change with respect to changes in interest rates. This is just to make the math simpler and also your life easier, okay? But for those of you who are familiar with ISLM, okay, we're still just borrowing stuff from ISLM. So just to review, in case, just make sure you guys understand opportunity costs. So for investments, if R increases, if interest rates increases, which direction should I go? Should it go up or down? All else equal. So if interest rates go up, opportunity cost goes up. Does investments go up or down? All else equal. Are you sure?
Interest rates go up and you're asking are investments going up?
Yes. Should you pour more money into investments? Riskier investments?
No.
Yes, no. It should go down, right? So it's a negative relationship between interest rates and investments. Just to double check with you guys, okay? So logic here is when we think about investment, we think about risky investments. Intuition here is if you have higher interest rates, that means the benchmark to beat is higher as well, right? And so if you're risk averse, you're going to be most likely, some people who are more risk averse will most likely move money away from risky investments into safer returns, right? R. So the example now I think of like interest rates, I think CDs, fixed deposit returns now is like 4 to 5%, right? That's quite high. And I can imagine people taking money out from risky investments and putting into these CDs now, okay? That's what you should be thinking about if you've been reading the news, yes? All right, so just to check, but for this class, just assume that there's no relationship between I and R. We're just going to keep it constant, okay? Unless I tell you otherwise. It does not respond to R. All right, so let's build up the aggregate demand model. So aggregate demand is very much just borrowing stuff from what you already know from GDP and GNP. So the components are the following. Aggregate demand consists of consumption. Makes sense, right? Again, aggregate demand means demand for output. Okay, the total output of an economy over, for example, a fixed horizon of time. So I plan to consume, for example, I don't know, 1 car over the next year. That would be captured by C. And that means your country or economy is expected to produce that 1 car to meet that demand. Okay, that's what C means. Not only consumption now, but also planned expenditures within that fixed time we're analyzing, perhaps up to 5 years or so, right? Short to medium term. Investment demand, same thing. So if you're going to invest in, if you're going to demand certain returns, right, from, for example, the stock market, we assume the stock market will eventually meet that demand somehow, okay? Either new firms are founded or existing companies have new investment opportunities and gives people the opportunity to put their money in, make a return. Government demand. So this is government spending. So government spending translates to not only consumption, but also savings, right? And that should also be captured by total demand as well. And lastly, current account. So this is net foreign demand. So it not only has to satisfy demand domestically, but also demand from abroad. So an economy, for example, producing cars, producing cell phones, if there's excess demand beyond your own country, your country has to produce just enough to satisfy that demand as well, right? Not only domestic demand, but also foreign demand. So the aggregate demand, I didn't tell you what the function looks like, right? So far you're probably thinking, maybe do I just add up all these numbers or add these components? Well, that's a possibility. It's possible that a country can have a linear demand. Okay, it's possible, but we like to be rigorous as economists, so we don't specify what that demand function looks like. Okay, we're just going to assume that it takes these parameters and it spits out something, right? Total demand. I'll show you soon. But anyways. All right, so let's dive deeper into these components. So we want to know how what parameters C, I, and G should take in our aggregate demand function. So I, for now, last bullet point, just assume that it's a constant. That's why there's an I bar here. So the bar here means just assume that it does not respond to any other variables in the model. But of course, if you remember your ISLM, it's R minus inflation, right? But anyways, you can ignore that for now. All right, so for C, we talked about this already, right? When it comes to the current account, consumption is driven by disposable income. Disposable income, as you learned from week 1, is national income, but we proxy with GNP, minus taxes that needs to be paid, either household taxes, income tax, or corporate tax. Anything that's residual, you use for investments or for consumption today or whatever. Therefore, we can rewrite C as a function in this manner, right? C is equal to C y minus t. So if we write it this way, in our aggregate demand function, we can kind of ignore this C variable, right? So, and when I write the aggregate demand function, I will just write the input, okay? As you'll see in a few slides. All right. So this second bullet point is kind of a very minor detail, but it will explain why the graph that I'll show you in a few slides, it looks the way it is. So in the case in which all income is spent on consumption, then we can kind of say that changes in national income will change aggregate demand 1 for 1. Yes? So if I give you $1 extra, that extra dollar is used all in consumption, then that boost in consumption will be, you need to produce it, so aggregate demand will increase by that same unit of money, right, or real income. Yes? 1 for 1. But in reality, a lot of you most likely will save that extra income. Yes? So if you receive an extra dollar, you may save 50% of it. So the response to aggregate demand, therefore, is less than 1 to 1. So when you see the graph in a few slides, you'll now understand why the slope of the aggregate demand is not the same as output, total potential output. Okay. Again, the reason is because not everything goes towards consumption. If it did, aggregate demand curve will change 1 for 1, right, with respect to income. But it doesn't, because most people will save some of that money. So that's what it's safe here, right? The response of consumption to tax changes, or just changing disposable income in general, is going to be less than 1 to 1, less than proportional. And the reason is because part of that additional income, either from a tax cut or from government spending, is going to be saved. Right? So now you can think about why, why Hong Kong government is using vouchers instead of cash rebates, or just cash or tax cuts in general. They want you to spend that money, right? If they gave you cash, I imagine people just put it in the bank, or maybe just pool their money together and buy a house, right? Something like that. Well, anyways, that's something to think about from this second bullet point. All right, comments, questions so far. So we're just talking about the ingredients of the current account. All right, I'm sorry, aggregate demand. And I will show you how that demand function looks like very soon. So now I'm just going to recap a little bit about the variable that's going to link everything together, okay, which is the current account / Q. So as a review, current account equation we're going to be focusing on is the following, right? Think about now real goods and services. Don't think about too much about S minus I. EX minus IM. And therefore, we know that EX minus IM all can be parameterized with respect to Q. And therefore, our key determinant here for current account is therefore the real exchange rate EP star over P. And as you all know, also current account can be influenced by disposable income. And we know that from the previous slides, Y minus T. So the relationship between Q and CA and Y minus T, we should know. So here, we know that it should be a minus sign. Yes? Because if we have more money, we have more income. Some of that income is going to be spent on buying things. And when you buy things, somebody might buy something abroad. Yes? So as a result, there's going to be a negative relationship between disposable income and the current account. For Q, as you learned from the previous slides in the beginning of the class, it's ambiguous. But for now, we're just going to assume that it's positive. But you know why now, right? You know why, because we have that condition that we have to set so that the partial derivative of the current account with respect to Q is greater than 0, right? We have to come up with some condition. Suppose that condition is satisfied. And so in the framework we're working with for this week and next week, you can safely assume that Q will have a positive effect on the current account. So assume for now, increase in Q, increase exports, decrease imports. And decrease in Q, increase imports, decrease exports. All right, so you've seen this before. I've said this a lot in the beginning, so let me just repeat myself for emphasis. We're able to map imports in terms of Q times EX star because we can interpret Q as the price of foreign output in terms of domestic output. Then the equation we can ultimately work with is the following: EX minus Q times EX star. And as you saw from the beginning of class, you take the partial derivative. We can conclude that the volume effect is captured by the EX and EX star. If we increase relative price levels, if we increase foreign prices, for example, everyone will substitute away from foreign goods and services. So domestic output increases, but foreign exports also, foreign export decreases, right? Because everyone's substituted away from foreign goods and services. And so Q's impact on CA, at least through EX and EX star, is going to be positive. So another way of saying this is Q depreciation, right? Because Q goes down. Sorry, Q goes up. Q depreciation on the current account through EX and EX star is positive. And as we talked about earlier, right, the effect on Q through IM is somewhat ambiguous. And it all depends on whether we believe the value effect dominates or the volume effect dominates. But for now, let's just assume that the value effect is negligible. We're working in a period of time that's not in the very short run, like a few months. We're working with beyond 1 year, perhaps up to 5 years, something like that. So maybe I'll just right here see summary slides for derivation. Breakdown of volume and value effects. All right, so maybe I'll just conclude on this slide and we take a 10-minute break. Let me just summarize a bit. So this is just verbalizing again whatever I just repeated to you over and over again. So maybe I'll just read it to you. As the real exchange rate depreciates, domestic products becomes relatively less expensive. So real exchange rate depreciates means Q goes up, increases. Foreign products relatively more expensive for residents anywhere. Okay, yes, not only for the foreigners, but also for domestic corporations, households, etc. So in the short to medium term, the quantities or volume of domestic exports increases. Right, the partial derivative with respect to EX, with respect to Q, is going to be positive, whereas the partial derivative of EX star with respect to Q is negative. So for given prices, EX rises and IM and or EX star falls specifically. For the value effect, we're talking about the immediate short run in which volumes don't change, right? You can easily imagine this, right, in the short run where everyone has placed their orders. It's unlikely people will change those orders for the short run, at least for the short run delivery. Most likely impacts will be on a few more months than like 6 months, okay? Maybe up to a year. So in the immediate short run, contracted quantities of exports do not respond. As the real exchange rate depreciates, again, Q increases, the relative value, price times quantity of a given quantity of domestic exports, EX decreases. So that, again, that just means that foreign goods and services are more valuable, right? Equivalently, the foreigners' relative value of a given quantities of their exports increases, EX star, right? That minus EX star parameter you saw in the derivation. Okay, so after the break, we'll talk about the aggregate demand function, how to visualize it, how equilibrium's restored in the aggregate demand, how that's going to look when we plot it in terms of the spot exchange rate with respect to Y now. Okay. All right, so all right, folks, let's finish up today's lecture. So I intentionally went slow today because next week we were talking about comparative statics, and it's going to be very, very complicated. So I want everyone to kind of have the foundation, solidified in their mind to know what they're working with, so that when we talk about, for example, short-run, long-run effects of fiscal policy, it's crystal clear what's going on. Okay, because fiscal policy is very, very messy. It's very messy, as you all know from the ungraded homework set, right? When we change Y, it has a counteracting effect on E, right? That's something you saw already. So as you'll see next week, just how messy things are when we have fiscal policy on the exchange rate. Okay. Okay, so if no other questions about the inputs on aggregate demand or how the current account is modeled now, focusing on this volume effect, value effect, and its relationship to Q, let's go ahead and now talk about the DD and the so-called DD and AA schedules. OK, so whenever you see the word DD, we're talking about aggregate demand. I'm just using the double D just to simplify when I'm referring to this market. OK, AA schedule refers to what you've seen before. The money market and financial market is going to be captured specifically by the so-called AA schedule. And again, the framework we're thinking about is in the short-term equilibrium model, the T model. Okay, we will talk about the long-term model later, trying to impose, for example, the relative purchasing power parity in this short-term framework. But for now, just put it in the back of your head and don't think too much about it. So our task today is to show you visually what the DD schedule looks like. What does aggregate demand look like on a plot in which we're plotting E versus Y? And then see what AA schedule looks like when we, again, AA is the money market plus for FX market, but now in a different plot, right? Now it's Y versus E versus Y. OK, so combining the four components of aggregate demand. I told you can think about just adding it, which is fine. But of course, it's a little bit more complicated than that. We typically write it like this. But let me just talk about what we're doing here. So we're working with the so-called, again, the Keynesian model of demand, which means supply will always meet the demand. So demand equation is the following. D equals C plus I plus G plus the current account. It's written this way because whatever we consume, that's going to be captured by demand, and supply is going to be produced to meet it. Whatever we demand for investments, same thing. Okay. G also spending, whatever we use to spend. If it's goods and services, that's going to be captured by demand, and supply will meet to satisfy it. And net exports is demand abroad, right? Not only demand for goods and services domestically, right, captured by these equations, but also demand from abroad, which also must be produced, in which supply must be created to meet. We can simplify this model, right? This is kind of too many parameters, maybe also too much structure. We typically write demand function in this fashion. D equals this function D now takes consumption parameter, disposable income. So we won't write the C now. We're just gonna say it's part of the demand function now. D is now just a function of disposable income. Y minus T. Remember, Y is national income, or GNP, which is our proxy, minus taxes paid for household, that's income tax, sales tax, whatever. For corporations, that's corporate taxes. Investments, again, in this class, assume it's taken exogenously, externally. We're assuming that I does not change with respect to interest rates. It does not change to any other parameters. It's just taken as a given. G is government spending. And lastly, Q is the real exchange rate, which is going to be the driver, right, that allows us to connect E to the current account to demand, right? That's why we're parameterizing just Q, because Q allows us to access the CA, the current account, which will tell us how much to produce D. So this is what we're going to be working with. But just know that behind disposable income, we're talking about consumption as well as the current account. But for simplicity, we can just say that this consumption component will dominate the negative effects of the current account here. Remember, more income, more propensity to import, right? You can just assume that it's very weak. Okay, the effects are weak. So let me write some relationship indicators here. So here it's positive. More domestic income, more consumption, more demand. Investments also positive. Government spending, same idea. Q, we're going to assume it's positive, right? And in the background, we also assume that income responds more on consumption than imports. Right, that's kind of what I just said. Okay, so what am I trying to do here? What I want to ask you now is how should y change in response to E? Changes in E. So when we plot it, you can tell me if it's downward sloping or upward sloping, but we'll get to that soon. So maybe I'll write plus here and minus here, and this is plus. Okay. So these, again, plus minuses is partial derivatives, right? The slope parameter, but for those of you without calculus, it's just relationships between variables. All right, so let's talk about the mechanisms here, right? So we want to know how Q affects the current account and how it affects D, right? Q, we're talking about primarily about E, okay? So let's suppose we have an increase in Q that's going to raise the current account, and that's going to impact D because we know that Q has a positive relationship with the current account. But we could talk about this in several ways just to reinforce the intuition. So what does an increase in Q means? Well, it means that domestically, there's a depreciation in real terms of the currency, and that makes domestic goods and services cheaper relative to foreign goods and services. Again, Q equals EP star over P. You increase Q, increase foreign prices. That's going to make domestic goods and services relatively cheaper. That means more people want to buy domestic goods in terms of exports and also locally as well. Another way of saying this, a depreciation of Q shifts both domestic and foreign spending towards domestic goods. Yes? Again, from the price incentive, right? From the price incentive, everyone's moving towards domestic goods and services, not only locally, but also from abroad. And lastly, in terms of output, you can also state a depreciation of Q raises aggregate demand for home output when the volume effect dominates. Yes? So the first two explanations should be really crystal clear, right? If you did pretty good on the midterm. This price incentives, people more moving away from more expensive goods, substituting for more cheaper goods. That's going to boost exports, and therefore current account increases. And because the current account is now a function of demand, aggregate demand, Q therefore is positive related with demand. So if we change E, that's going to have a positive impact in demand. All right, so based on this last sentence, it should be clear. If we were to plot E versus Y, it's going to be an upward sloping curve, right? Upward sloping curve between E and Y. DD schedule. Okay. So I'll explain to you why it's called DD schedule soon, or why it's a schedule. Okay. All right. So let's just reinforce intuition. Let's go the other direction. So A decreases in Q. Decrease in Q means that the current account, which is assume the volume effect dominates the value effect, that's going to decrease current account. Current account is a component of aggregate demand. So if CA goes down, net exports goes down, then aggregate demand also goes down. Yes? So let's write out the sentences to characterize what I just said. So an appreciation of Q makes foreign goods services cheaper. Yes, that's one way to say it. Another way of saying it is an appreciation of Q shifts both domestic and foreign spending towards foreign goods services. Right? So in this case, decrease in Q means, relatively speaking, foreign goods are more expensive. I mean, domestic goods more expensive. So everyone's moving away from domestic goods towards foreign goods. And lastly, in terms of demand, an appreciation of Q lowers aggregate demand for home output. So again, this sentence characterizes an upward sloping curve, right? If we increase Q, we increase Q through E, output should increase. If we decrease Q through E, output should decrease. So far, so good. So first two explanations in both bullet points, just stuff you already know, from price incentives to move trade. The last sentence, based on the aggregate demand function I gave you, right, and its relationship. If I change Q, it's going to have a positive effect. It has a positive relationship on D, and because demand creates supply, there will always be enough produced to satisfy that demand. Yes? And so Y in equilibrium must move in the same direction as Q. All right, so let me show you what this looks like, what this Keynesian supply meets demand model looks like. All right, so this is called the Keynesian cross. It's called a cross because it shows a 45-degree line between demand and Y. So you notice that Y and D are the same, right? Because I told you, supply in a Keynesian aggregate demand model, there will always be supply created to satisfy enough all the demand. So D and Y basically the same thing. So plotting Y versus Y, the 45-degree line therefore plots an economy in which all income is spent on buying what's produced. Yes, whatever you make, it's just going to be buying everything that's produced. So if an economy looks like this 45-degree line, nobody saves, right? That's what this means. Nobody saves if all the money people make is used for consumption of all output. But in reality, that's not the case, right? People will save. People will save. And what Keynes suggests is that an economy's aggregate demand curve is not as steep of a slope, right? It's not a one-for-one increase. An increase, if you increase real income, it's not going to translate to an increase in output. It's going to lead to something less than that. And so that's captured by an aggregate demand curve that has a slope that's closer to 0. So something that's less steep. This is why it's called a Keynesian cross. This line here is our aggregate demand function. So maybe I will draw here 45-degree line, 45-degree. And let me comment here. It's called, this is when total planned expenditures equals total income. Sorry, total output. Yeah, it's just output. All right, so maybe I'll talk about how equilibrium is achieved later, but let me show you what the intersection means. So the intersection is the equilibrium in which output equals demand, right? Demand creates supply. So supply always meets demand. So given a country's aggregate demand function, if it looks like this, once they produce enough to satisfy all demand, that's where production stops, right? People stop making things, companies stop hiring people or firing people, and that's how much an economy produces. So I'm just write why not, because it's a starting point, okay? And here you can write D naught. All right. So let me ask you a question. If we are here, are we underproducing or overproducing? Yes, overproducing. As you can see, we demand this much, but total output is here. So here we have overproduction. Just write it. Yeah. All right, then if that's the case, then it should be clear what this gap means here. So here we are underproducing. Underproduction. Underproduction. All right, so let's talk about this so-called feedback mechanism, how we achieve equilibrium under this framework. So let's suppose we are in the underproduction scenario. So we're producing too much given our demand. What will companies do? Companies will have inventories that's growing, right? They have making too much, and they have too many people employed making goods and services. So what's going to happen is people will be fired, right? You have people being laid off, companies are shrinking, disposable income in the economy is also shrinking, and as a result, we will actually be moving, right? We will be moving towards here, right? Sorry, I'm talking about the other way, overproduction, sorry. In the case of our overproduction, we're moving from here to here, right? The economy is shrinking. So let me say it again. Overproduction. Overall economy is producing too much. Inventories are growing. Too many people employed. Too costly for corporations in aggregate to sustain. So what will they do? They curtail their productions. They lay off people. This cycles back. People have less income. Corporations shrink. And as a result, we will be moving from this point here towards this intersection here, right? And the scaling back of production stops precisely when demand is precisely met with supply from the economy, from all the corporations and so forth that makes the goods and services. Until supply meets demand, we're done. Now, for underproduction, it's the other way around, right? When demand exceeds supply, corporations, businesses have incentive to expand. Their inventories are shrinking too fast, and so they have every reason to scale up to make profits, and they'll do that. And as they do that, they will move from this point here towards, right, this intersection here. So as businesses expand, they hire more people, making more wages, everyone has more consumption, it feeds back into production. It will keep doing this until enough is produced to meet overall demand. So let me write the intuition here. So we have overproduction. So what goes on? This means that inventories increasing too fast, too many people employed, scale back, scales back production by laying off people, by layoffs. Income decreases, equilibrium, when output equals demand, right? Supply equals demand. And the rationale is just the reverse, right, for underproduction. Inventories shrinking too fast, more profits if expand labor expand hiring. So you hire more people, you pay more people, right? So income increases. And then equilibrium when supply equals demand. So it's a very, I guess, it's a recursive framework, but it's a framework that economists have been using for, modern economists have been using for quite a while. Okay, so this is our aggregate demand mechanism, so to speak. Okay, I may ask you to regurgitate the mechanism, but to be honest, when looking at the graphs itself is not that important. But this is what's behind. What's going on behind the curtain, so to speak, behind the scenes. Okay, comments, questions on the Keynesian cross. So Keynesian cross, so let me summarize again. Keynesian cross is a way to explain the mechanism in which demand creates supply. It's called demand creates supply because we're assuming that there will always be somebody, namely corporations, to create output to meet the demand. So all we need to do is model demand, and we can just safely assume that supply will always find a way to meet it. Demand takes parameters we talked about in class, right? Consumption, investments, government spending, and the current account. We kind of ignore the C here and just parameterize everything through D. Right? So we just talk about disposable income, Y minus T, investments, G, and Q, as you know, is just Q because we've kind of hid the current account variable through Q, right? In this framework, we're assuming that Q has a positive effect on the current account, and we're also assuming that disposable income is primarily driving consumption as opposed to imports. So as you increase disposable income, aggregate demand is still going to increase in response to that. All right. So the mechanism. The mechanism is the following. Through this graph, we plot aggregate demand at a slightly flatter curve than this 45-degree line because people actually save in reality. When you make more money, not all of it's going to go towards consumption, right? If it did, then it would have the same slope as this as the vertical, this 45-degree line. Okay, so mechanism. Two scenarios to think about. One is if there's an overproduction, and the other is underproduction. Overproduction means that two things. One, inventories are growing fast, and number two, they're producing too much with the given amount of labor. So the economy needs to shrink, essentially. The labor market needs to shrink. So as they scale back on production, they're laying off people. Obviously, when they do this, income in general will decline, right? And this will feed back into this demand equation over and over again until just enough production or supply is created to meet the demand. So that's in the case when you have overproduction. For underproduction, it's the other way around, right? Every corporation has every incentive to expand production because demand exceeds supply. Their inventories are shrinking, so they're going to increase their production and hire more people to make it. So as they increase their hirings, income of the overall economy is expanding. With more income, they're going to demand more goods and services, and the economy is going to keep expanding until enough production is there to meet the demand. So y equals d, essentially, right? So this is all it's all recursive, right? Feeding back until we restore balance or equilibrium. So I think the hard part to understand is just this recursion and feedback, right? The recursion comes from the fact that people are losing money when there's overproduction, but people are making money when there's underproduction. As they make more money, more output is demanded, and that's where we're moving from the part of the line that's not at the intersection, right? And every point outside of that has every reason to move towards the cross, right? The intersection. So the feedback comes from Y, income, from layoffs or hiring, right? Okay, so that's, I hope people see that, right? Here is let's say YU, and here is YO, right? This is the output level. The current output level at this point is too much, so you want to move towards here. Here you have YU below Y naught, but demand exceeds what's being produced. So you have every reason to move towards Y naught. And as people get wealthier or people get laid off, that's the mechanism that allows us to achieve the Keynesian cross. Comments, questions on the mechanism of how demand creates supply, essentially. Okay, now let's talk about how to characterize the relationship between E and Y with the Keynesian cross. So in the short term, we're going to assume that, as usual, relative PPP does not hold. So prices don't respond to anything. It's going to break down as E moves, and therefore Q moves. So when E moves, Q is going to move. Q is not stable. So we're not going to assume relative PPP holds for now. All right. So what should we expect when we change? What should we expect when we change E? So I'll give you 3 ways to think about it. The first is if we increase E, that's going to depreciate the domestic currency in real terms, right? And that's going to make domestic goods and services cheaper relative to foreign goods and services. This is something you've heard over and over again. We can also say that a depreciation of E shifts both demand and foreign spending towards domestic goods. Again, something I said over and over again. And lastly, this is something new, right? A depreciation of E raises aggregate demand for home output when the volume effect dominates. So this is the new takeaway today, as you saw from the aggregate demand model we have, right? So how do we visualize this with the Keynesian cross? Let's go ahead and do that now. So this Y is the assumption that all income goes towards output. This is a 45-degree line. And let's assume that aggregate demand looks like this. I'm going to call this D, Y minus T, I, G. And for clarity, I'm going to write EP star divided by P. Okay? All right. Let's talk about if we decide to arbitrarily depreciate the nominal exchange rate from E to E prime, assuming that E prime is some larger value than E. So what's going to happen? Well, if we look at this equation here, you see that E enters the demand equation from this point here, but E is not on any of the axes. So it's not a move along the curve. So as I explained to you in the previous weeks, the intuition here, the rule of thumb here is if we change a variable, that's not in the axis, then there must be a shift in the curve. OK, well, how does it shift? Well, think about it this way. So remember at this point here, we have essentially y equals demand. Yes? Now, if we increase y, so I'm going to erase this here because it's confusing. If we increase E, what's going to happen, assuming y doesn't change immediately? What's going to happen is y is going to be less than d. Yes? And then dot, dot, dot is all the parameters. Right? When we increase E, Q is going to increase. And relative price explanation is foreign goods and services more expensive, domestic goods cheaper. So that's going to boost output for sure. So this point here is going to jump. Right? So we're going to create there's going to be an underproduction. Yes? As you saw in the previous slides. Right? We want to create an underproduction from that point. All right, so we've jumped from this point to this point, but we are not in equilibrium, right? So let's call this y naught. And as you can probably already guess, I'm going to write this d prime here. We want to have an explanation that we actually move from this point over to this point here, right? That's kind of what we want to do. So let me explain to you what's going on here, the intuition. So what's going on is because we have elevated E, and as a result, elevated Q, we have less import competition, right? Because our goods and services are now relatively cheaper. Or you can think of it, our domestic goods cheaper. So obviously, from demand creates supply perspective, right? Supply must be created to meet demand. So the economy is going to ramp up their production. Yes? More output created. As more output is created, firms are expanding their inventories, they're expanding their labor pool, right? They're hiring more people, and more people are making money. And so that feeds back into Y, and therefore Y continues to create more supply. Yes? That's why we're moving along this curve here. Feedback. Right? More income, more output, and as a result, more output, more supply being created from that demand. So therefore, we move along the D curve, the new D prime curve. There's a name for this. There's a name for this movement here. This is called the Keynesian multiplier. The multiplier is just a fancy word for feedback. Okay, and the feedback is from income that's driving output. Output creates more income. Income drives more output. That's the feedback. And as more output is created, it stops when all of demand is completely satisfied by what's produced. All right, so just to be absolutely clear, let me outline the assumptions I've made so far. That's in the background. So I assume that income effect dominates import effect, right? Remember, CA also takes income as an input, but I kind of ignore that. By doing that, that assumes that consumption is the primary effect coming from additional income. Okay, and also I assume that Q increases CA, right? Volume effect dominates. Okay, so this is the mechanism at play when there is a shock or a change to E. So if central banks or the government wants to impact E to boost output, well, this is the mechanism here. Okay, according to the Keynesian model of aggregate demand. The way it works again is you create an underproduction scenario, right? Because the devaluation of your currency and the extra income, the extra incentive for corporations to expand output requires them to hire workers. Part of that income shared with the workers. That income feeds back and boosts output more output, more income, and that keeps feeding back until supply meets demand. Okay, supply meets all planned expenditures. Okay, comments, questions? So the takeaway from this graph is not it's the mechanism itself, but what we're going to be using, what we're going to be using from this conclusion actually is the following. We just want to know, well, based on this graph, it's quite clear that if we increase E, right, which is what we did here, output increases. That's the main thing we're going to pull apart from this graph, okay? But that's the mechanism at play. All right, so based on that relationship, we can now talk about the DD schedule. So remember what the DD schedule is doing, the DD and schedule. It's characterizing the Keynesian cross when plotting E versus Y. That's all we're doing, okay? And based on this explanation here, we know that the relationship between E and Y is what? Is it positive or negative? Yes, positive. So if we were to characterize E and Y for aggregate demand, it must look like something like this, right? Something like that. DD. Oh, sorry, DD. So what does each point on this DD curve represent, however? Each point on this curve represents an equilibrium condition. Namely, y equals d minus d, which takes parameters y minus t, I, g, and EP star over p. Right, EP star over p is just q. Okay, I'm writing it out just to clarify that there's an e in that equation. Okay. So let me say that again. Every single point here, every combination of e and y on this line, it is a market clearing condition. It is saying that y equals d. Namely, for different values of e, it will give you different values of y according to this relationship, this plot, which is positive sloping. Okay. So as you will see, when I combine the DD schedule with the so-called AA schedule, which summarizes the financial markets as represented by the FX market and the money market, when the DD and AA schedule intersect, that's literally when all markets clear. Yes? The financial markets are cleared in equilibrium, UIP is satisfied, money market is cleared, right? Real money demand equals real money supply, and the DD schedule is also cleared, right? That means the real economy is clear. Supply equals demand. So let's take away from this plot is here is when you increase E, you will increase Y. And this relies on two assumptions, right? Primarily two assumptions. Because, one, Y minus D is assumed positive on D. And two, we assume Q is has positive effect on CA. All right. So to emphasize, the DD schedule is a representation of all possible equilibrium for different values of E and Y. Every point on this line suggests or means that demand equals supply. Okay. Every point on this DD schedule means that supply equals demand. Therefore, we are in equilibrium. All right, so let's now combine the DD schedule with the financial markets, as represented by the money market as well as the foreign exchange market. So you know this. FX market is represented by UIP, the uncovered interest rate parity. You know this. Real interest rate differentials is equal to the expected depreciation of the domestic currency. If that's satisfied, we have market clearing in the FX market. That means carry traders have no incentive to come in to borrow or lend out in different currencies. The second component of the financial markets is the money market, as represented by real money supply and liquidity demand. Liquidity demand, which takes parameters R and Y. So we can easily combine these equations into one equation, right? We have R here. We have R here. So we can actually rewrite the financial markets into one equation, right? Namely, this equation with these terms plugged into here. Okay, so we want to characterize that single equation on the plot you just saw on the previous slide, E versus Y. Okay, so I think we know this for sure. Asset market equilibrium relates E to Y, and based on these two models, can someone tell me what's the relationship between E and Y? Is it positive or is it negative? We can work through this. Let's work through it. So I'm going to just draw a starting equilibrium, which you've done many, many times in your studies for the midterm. So I'm just going to do this quickly. So we have a starting point. This is E naught. Now we have a temporary increase in output. Let's increase output from Y to Y prime. We know that liquidity preference curve moves away from the origin when there's an increase. So let's call this LRY, and this one LRY prime. So the final equilibrium effect, we have higher interest rates, but we also have the following effect, in which the spot exchange rate declines. So we have the opposite relationship in the asset market. So the takeaway here is E is negatively related to Y in the asset or financial markets. Okay, insight. Let's talk about insights here, just to make things clear. So we have high income, or just mechanism. Mechanism. I think it's a better description. Mechanism. High income will lead to higher consumption. You will dump assets for cash. Bond prices drop. R increases. And then you have carry traders come in, right? Domestic currency must depreciate in the future, so appreciates today due to UIP. Or you can think of it as, in this case, or carry traders. Carry traders will borrow foreign and lend domestic. So this is all review, right? Nothing crazy, right? This is nothing crazy. This is something you've seen before. All right, so let's just plot this relationship on this graph. So when looking at E versus Y, we know that there's a negative relationship. Let's call that the AA schedule. And just like the DD schedule, this line is a representation of equilibrium. Different types of equilibriums for different combinations of E and Y. That's why it's called a schedule, right? Because we're looking at different combinations of E and Y that allows the market to clear in the asset market, either FX or money market. That is represented by this equation, which I'll write now, which I asked you to do already, right? We combine UIP and the money market equilibrium equation into one. R star plus E hat, E hat, I'm just going to write E hat E over E minus 1, okay? Just to make notation easier, and then Y. I hope it's clear that this can be done because this is just equal to, this is equal to R, right? Due to UIP. So hopefully you can see this, right? If we increase Y, that's going to increase output, right? And this is going to cause a disequilibrium in this equation, right? This is going to be positive then. Something has to respond in E to reverse this effect. And this reversion can only take place if interest rates also increase. Interest rates can increase if E decreases. So this is a negative relationship, right? And that's why we have a downward sloping curve. So the intuition here is if you have a booming economy, then you're going to have appreciation of domestic currency. All right, this makes sense. If everyone's wealthier, everyone's buying things, then a lot of that purchase is going to go towards importing goods and services, and everybody wants to demand local currency. So that's going to boost the strength of the domestic currency, and therefore E has to decline. And what I just described here is the following, right? We have you have to have an decrease in E, which will decrease L to undo increase in Y. So let me summarize AA schedule again. AA schedule is a representation of all market clearing scenarios for different values of E and Y. That's why it's called a schedule. That means every point on this graph represents market clearing conditions, market clearing scenarios for the money market as well as the financial markets or the FX market. And the way to think about this is suppose this equation has to hold. If this equation has to hold, then when you change y, then E has to move in the other direction that offsets it, right? All right, so comments, questions on the AA schedule. So the next step, obviously, is to combine both two and then explain to you the mechanism in which there is a arbitrary deviation from equilibrium and how equilibrium is restored. This is OK. So let's combine the two. This is AA. This is DD. And let's get into the habit of writing the equilibrium equations for both scenarios, for both schedules. Right? That's what the AA schedule represents. The DD schedule, on the other hand, represents demand creates supply. And so naturally, our equilibrium is this intersection, which means that every market is cleared. Supply equals demand, no incentive to conduct carry trade or arbitrage. That's what this intersection represents. All right, so let's talk about a deviation from equilibrium. Let's talk about how equilibrium is restored. Now suppose that we're here, right? Just randomly, we're just here now, okay? For unknown reasons, no explanation whatsoever, we're now here. So let me talk about graphically what happens, and then I'll describe to you, I'll type out the mechanisms. So what happens first, as you expect, is if there is something that doesn't make any sense, the financial markets are the first to fix it, okay? So what that means is if we're ever in the spot in which we're outside of either curve, the first curve that will meet the market clearing condition is the asset market, the financial markets. And so what you should see is this point should very quickly drop onto the AA schedule. Okay. Once we are on the AA schedule, there is a feedback effect at play. And you can see this because, obviously, there's a y here, and a y here, and a y here. Yeah. So what's going to happen over time, as you can imagine, is our equilibrium point will start move towards the DD schedule until we achieve our initial starting point in the first place. All right, so let's talk about the mechanisms. Let's talk about the simple part. The simple part is, well, suppose we have E prime that exceeds E naught, right? That's exactly what happens. What's the first thing that happens? Carry traders come in. Yes? Carry traders come in. In this case, when we have higher E, that means foreign deposit rates are less attractive, so they'll borrow foreign and invest in domestic, right? Carry traders clear the market, or carry traders restores UIP and appreciates domestic currency. Borrow foreign, lend All right, so remember, when we drop to this point, we are still at this output level, right? Now, for this level, this level of, let's call that E double prime. For this level of the spot exchange rate, we are still underproducing, essentially, right? Because we are not on the demand curve. The demand curve requires us to be here, right, at the minimum. So with an elevated E, we have higher Q. That's going to boost more output, more money is being created, right? But with people with more money, they're going to demand more goods and services. That's going to keep appreciating domestic currency, which is why we see a downward trend, yes? And that's going to feed back into output. So this is the hardest part of, I guess, this model and perhaps this class, okay? This feedback effect is kind of hard to think linearly, right? It's not nonlinear. So let me say that again. After market clearing in the financial markets, we still have an elevated spot exchange rate, right, for a given output. That means that we are underproducing. So there's a price incentive. Foreign goods are more expensive because higher E means higher Q. As the economy expands, they're hiring more people, they're producing more, there's more income. That's going to put actual downward pressure on the domestic currency, E, because domestic currency is getting stronger. So E keeps going down, but output keeps increasing until all output is satisfied and E no longer wants to move anymore. That is precisely this point here. Okay. So that's the mechanism. The new mechanism here, that's a bit, it's recursive, meaning there's a lot of feedback, looping, right, from one equation to the other. But this is how equilibrium is restored in this setting. Okay, so this is the last slide for this slide, and I'm going to go to the summary slide to kind of reinforce all of this again. So any comments and questions on this picture? The first part I think everyone understands, right? This part should be clear. Financial markets responds immediately. Carry traders come and exploits this anomaly until this expected returns, expected profits on carry trade is 0. But in this scenario, E is still elevated for the amount of output, right? Because we're not on the DD curve. From the Keynesian cross, right, when there's higher Q than given the output available, corporations and firms have every incentive to expand to meet the excess demand. They keep increasing output. There's more income being generated, but more income is going to feed back into demanding more domestic currency, right? And that's why E is going to get stronger. Sorry, domestic currency is going to get stronger over time, but output is also increasing as well. But this effect is going to stop once supply meets all of demand. And that's why we move from this point here all the way to this point here. All right, so let me summarize quickly since we have 8 minutes left. All right, so I introduced to you what's called the Keynesian cross. The Keynesian cross is precisely just plotting output on output, okay? The 45-degree line is the assumption that all income that's generated is spent on production. You buy whatever you produce. That's definitely not true in reality. People save. That's why the aggregate demand curve is assumed to be less steep and more flat than the 45-degree line. We also learned that aggregate demand takes multiple inputs, namely consumption, which is captured by disposable income, investments, government spending, as well as Q. Q is, again, the key variable that relates the current account with total output. The current account represents net exports or output demand from abroad. So equilibrium is when the intersection between the 45-degree line and the aggregate demand curve because there's no unmet demand, there's no overproduction, and there's no unintended accumulation of inventory, so no overproduction either. Whenever there's a deviation, there's always incentives to increase inventories or decrease inventories and scale back production or increase hiring, right? One direction decreases income, other direction increases income. And there's a feedback effect, and it will stop feeding back once enough supply is created to meet that demand. We know the relationship between the DD schedule because we know the relationship between E and Y because we've literally did an experiment in which we increased Q, right? And we saw that E and Y must be positively related with respect to output. And the mechanism in which we approach the equilibrium is called the Keynesian multiplier, right? Again, it's the feedback effect in which people make more money because of more output that drives more output, and eventually you'll converge on equilibrium will be restored when enough supply is created to meet all output. The AA schedule, I think it's clear. We understand exactly why Y is negatively related with E, precisely because when there's a boom, more people want to consume. They want to hold on to more cash so that they can buy more goods and services today. And what's different from before is now we're combining UYP with the money market equation, right? Namely, we're just plugging in R with R star plus E hat E divided by E minus 1. Yes? The intersection of AA and DD is precisely when all markets clear. Financial markets clear, and the real economy clears. And the final thing I want to talk about is how equilibrium is restored, right? The market, the restoration of equilibrium is clear for the financial side, right? If there is a aberration away from equilibrium, financial markets react first. Carry traders come in the scenario I outlined to you, they borrow foreign and lend out domestic. They keep doing this until we're on the AA schedule. But when we're on the AA schedule, that level of Q is mismatched with the output, right? In fact, there's an underproduction, right, in that scenario. And so what has to happen in the real economy is the economy has to produce more goods, hire more people, increase income, and produce more. And this feeds back into itself until we are ultimately satisfied with market clears in the real economy as well. OK, so that's